So I am very excited to introduce next up Michelle Bustamante, who's a CPA, a CCA, and a CCTA, an incredible tax advisor, one of my favorite people on earth. I don't say that lightly, although I tend to be surrounded by a lot of my favorite people on earth. As a former coaching student of mine, she was literally our #1 implementer of everything that Chuck Bauer and I taught in the CCA program. That amazingness led her to actually acquiring my own CPA firm, Meyer Tax, in 2022. Her firm, Ardent, has made such an impact that my former clients have pretty much just completely forgotten about me, which is it's kind of sad, but that's okay. That's good news, right? So she began her career with an undergrad degree in music, but couldn't ignore her love for numbers. And that passion led her back to school to accounting, getting her CPA license in Texas. And her mission is really to help small businesses thrive through smart financial planning. Today, she really carries that mission through Ardent CPA. And by the way, she still gets to use that music degree. Her husband's a pastor and she gets to sing on stage, and her son is off stage air drumming. So please welcome Michelle Bustamante to discuss some advanced tax strategies you don't want to miss.
Awesome. Thank you so much, Jackie. All right, give me just a second for the technical things. Let me share the right screen. I think that's the part I'm scared about. So, all right,
you are all set.
Success. All right. Yeah, thank you, Jackie. I'm pretty sure that you asked me to present on this one because I'm the fastest talker on the planet, and there are a lot of things to cover in the next 40 minutes, but I'm going to try to slow it down. We'll see. Okay, so let's just start with, okay, so I guess I want to back up just a little and say, with my firm, we have about 85 clients and do about 220 tax returns, which seems really small. But our annual revenue is just around 1.5 million. And the only reason I say that is because some of you guys need to hear that you don't need to be doing tax returns for $500 a piece, all right? We are worth more than that, and we have much more to bring to the table, which is why you're on this call and webinar today anyway. So we're going to talk about high net worth business owners. They have a very complex tax scenario, all different specifics. No one tax picture is ever going to be the same. And so many accountants are focused on the compliance piece that they neglect the advanced tax planning and miss out on opportunities to save taxes. But using these strategies can actually maximize their wealth retention and produce an ROI. All right, so I am going to cover actually 6 today, because Jennifer is amazing and gave so much information on the cash balance plan. I'm going to kind of skip over that, but there are, guys, I think there are 65 slides in this presentation. So get that VIP package to get all of the recordings and slides, and you get a copy of Dr. Jackie's ebook that has all of the deep dive material. So when I talk too fast or I skip over something that you wish I hadn't skipped over, you can go back and do it at your timing, okay? The main thing that I want you to walk away with today is that you don't have to know everything in order to advise your clients, all right? And that seems like a really scary thing for accountants because we love to nerd out on all the details. But 3 things that I would say are the most important thing that you can do in the tax planning realm is, number 1, knowing your clients. And I'm pretty sure somebody's going to talk a little bit more about that today, but what are they passionate about and what don't they agree with? What are they more aggressive or risk averse? Do they have cash available to implement the strategies? Can they keep records detailed, or do they need hand holding, right? You need to know these things about your clients. Number 2, you need to know or you need to build your arsenal of strategies. That doesn't mean knowing every single detail about every single strategy. It means knowing what strategies are available and which strategy or which situations they work for. From there, then you utilize Tax Plan IQ for the wealth of information and resources that are available. Collaborate with experts who can help you fill in the blanks. Again, going back to, you don't need to know everything, all right? I use Tax Plan IQ on a very regular basis. And I actually also, my company teams up with an advisor from Anton Anderson's team, who you'll hear from later. They help answer all the hard questions and assist in implementing the strategies. So as I'm meeting with potential clients and getting to know them, I am determining in my head which strategies could fit well for their tax picture, provide a very, very basic overview, and kind of see what piques their interest. From there, I'll get them on a call with me and my team to dive deeper into answering those questions. And that's why you don't have to know everything. All right. So I say that all to get us into 7 strategies. Let's see, did we go? Okay. 6 that we're going to talk about today, because we get to kind of skip over number 4. But I say that because we're going to go into so many details that I don't want you guys to get upset that we don't touch every single detail in this deep dive. Okay. All right. Let us start with the Family Limited Partnership, FLPs. This is a legal structure that is created to manage and transfer family wealth. You must have a legitimate business purpose. Family members are going to pool together money to run a business, invest in assets, grow their wealth, things like that. This is going to work well for families that have substantial assets, all right? Generally over $1 million, whether it's in real estate, investments, business interests, things like that. And they're looking to transfer their wealth to the next generation and save on taxes along the way. So I am going to skip a few more slides because I think that this case study will kind of show everything in action. All right. Let's talk about John. All right. John has some significant assets that he wants to allocate to lower tax bracket family members and eventually pass on to them. So he sets up an FLP and he transfers his investment portfolio of $5 million. He maintains a 1% general partner interest. With this general partner interest, he maintains control over the asset management, which means regardless of how we allocate the income, his general partnership interest means the kids can't just run away with the money. So he still has control of those assets. Then with 99% limited partner interest, his family members who are at a lower tax bracket can receive a higher income allocation for future returns on the portfolio. This is where you're going to get the income tax savings, right? John is paying less because he's only got 1% rather than the 99% or whatever income allocation we do. Still paying tax at the lower family members rates, but it is at a lower rate than where John is, okay? Next, the future income and appreciation on these assets are not included in John's total estate. So if you remember that assets worth 13.6 million are subject to, over that amount, are subject to estate tax when he dies at 45%. So if you've got clients that are coming up near that $13.61 million in their estate, anything you can do to bring that number down, they're going to save 45% on that. So if the new growth that comes with these assets that have been transferred are not part of that limit, it is safe from that 45% estate tax when John dies. We like that. All right, so you can do this over time, a little bit year over year, or you can do it kind of all at once, but you can transfer the interest to the limited partners with a valuation discount, right? This is one of the very important aspects of it. So in this scenario, John is able to use a 25% valuation discount to transfer, meaning that $5 million is actually only $3.75 million of value. And that means that 1.25 million is now gift and estate tax free. That's huge. All right, so then we get into the gift tax savings. Each child, if we split that into, each child receives the $2.5 million, but the discounted value of 1.875 million is what is taxed. So this is 625,000 of tax-free income that goes to each child. You can apply the $18,000 annual gift tax exclusion and then file a gift tax return, but you can apply the remaining 607,000 to the lifetime exemption. So you're getting out of the estate tax on the future earnings. You are getting to utilize gift tax to transfer those assets. You're getting to take advantage of the valuation discount. Basically, it's just this incredible way to capture significant tax savings on transferring things to the next generation, which is awesome. All I want to say about establishing an FLP is to get an estate planning lawyer. Use one of the preferred vendors. Tax Plan IQ has one in there, I believe, as well. You can still come alongside, advise on general versus limited partners and allocations and jurisdictions, but let the attorneys handle the details. Okay. There are some things that you want to consider as far as challenges, because they are not the simplest thing to put into place. It does cost money. The IRS may look at it a little bit more, and then families, let's be honest, sometimes they can be crazy. So you've got a little bit of extra that can go into it, but what a beautiful place to work with families and transfer all of these things. So we are moving on to number 2, which is the research and development tax credits. All right, so several of the strategies that we are going to talk about today are government incentives. That means the government is encouraging companies to use, or not companies, encouraging taxpayers to use their money rather than government money to fund initiatives that they have. So in this instance, they are wanting to fund research and development. All right, so use your money as a taxpayer and get the credits. All right, big savings. It is a bit of a hot topic because there have been some changes recently, and we are going to go over those a little bit. Few things to note is that the goal of this is to encourage scientific and technological, it's a big word apparently, advances. Innovation is what is most important. It's not about the success of that research actually turning into something. It's that we're trying new things and innovating. All right, so again, this is one with a lot of details, so get that VIP package. So you got the slides and the ebook, so you can get into all the nerdy details. But let's talk about the overarching of this, of what has happened most recently. So we have taken the UK's Small and Medium-Sized Enterprises R&D Tax Relief Program and the RDEC, which is Research and Development Expenditure Credit, and then we simplified it across the board so that both small companies and large enterprises are getting advantage, or getting to take advantage of it. All right. So now both small and medium-sized businesses are able to take advantage of the 20% credit rate that large companies have already seen. The trade-off is that they will see a reduction in the additional deduction rate and payable credit rate for losses. Then they've got the ERIS, which is the Enhanced R&D Intensive Support. This is for like the supercharged side of it. If your client has more than 30% of their expenses as qualified R&D, they are getting more support from the government in this. Okay, it used to be 40%, but they opened it up or brought it down to 30%, so it opened up the eligibility quite a bit. So very exciting things. Fun. They are now including data and cloud computing costs, which were not there. So we're now like in the modern digital world, which is very exciting. Guidelines. So it used to be that subcontractors and the main companies were submitting claims and there were duplicates and it was very confusing. And so now subcontractors are not supposed to submit the claims. There is an R&D decision maker in the company that will be responsible for the claim. And that's where they're going to help prevent all the duplicates and things like that. Practical implications. This is very heavy on compliance and documentation. So number 1, if you know your client is not good with record keeping, this may not be a great strategy for them. This tends to be a strategy that gets audited a bit more. And so if they don't have the records to back it up, it's going to get blown up. So I wouldn't recommend it for those clients. The other side of things is use a preferred vendor. I do not recommend submitting these claims by yourself because of the higher risk of audit and things like that. Your preferred vendor is going to know all of the ins and outs and be responsible for crossing all the T's and dotting all of the I's. Okay. All right. Number 3, this is probably one of my favorite areas to talk about, is charitable tax strategies. So we're going to touch on, I don't remember if it's 4 or 5 different strategies in the charitable world. Many of our high wealth business owners are charitably minded. Some of them do it because they get the deduction, and some of them do it because they actually really want to give. And so our job is to help them capitalize on their desire to give and save on tax while they do it. So, I mean, if you save more on tax, you have more to give. right? So we're looking at some strategies where we can do this. I'm going to skip over the summary and get into the details. Charitable LLCs. This is a fun one. This is, it allows a blend of both charitable and profit generating ventures. It's going to provide the tax deductions and and allowing them to maintain control over the charitable missions. All right. So the operating company donates to the charitable LLC and gets a tax deduction. Then the charitable LLC can give just as a nonprofit would, but also be able to invest in for-profit companies. All right, it creates additional income, and then that can be reinvested into the mission of the business, which is really cool. So what's great about this is founders are going to have more control with less restrictions than a traditional nonprofit. All right, the charitable remainder trust, often referred to as a CRUT. This is a really cool one. So you transfer assets into the CRUT. This can be real estate, stocks, etc. You're going to receive an immediate deduction based on the present value of the remainder interest designated for charity. It's nice and confusing, all right? But the main benefit is deferring capital gains taxes. So the trust sells tax-free and reinvests in a diversified portfolio. Then the income from the portfolio can be distributed to you as income or named beneficiaries and provide a reliable income stream. Now, your trust can be tailored to meet both income needs and charitable desires. So you get to basically decide at the beginning what that value is going to be given to charity. By some is given over time and some is given at the end of that time. And you get that deduction straight up front, even if it's given over time. And then because it is growing money, you have an income stream for yourself as well. The trust terminates either at a specific term or upon death of the beneficiaries. And at that time, anything that is left in the account goes to charity. All right, so you get to give to a charity, and this is not included in your estate. So you get to save on those estate taxes as well. Donor advised funds. Y'all, this is the simplest, I think, and probably the most popular way to get that immediate deduction, but have the ability to give to charity over time. You can donate cash, stocks, appreciated securities, and doing the latter with the stocks and appreciated securities allows you to avoid capital gains. Instead of selling the stock, paying the tax on the gain, and then gifting the rest, you get to contribute the full value of the stock. And it is as simple as looking at this as a charitable savings account. So when you put into the donor advised fund, you're saying, okay, I'm going to put in $100,000 this year. You may not know exactly where you want it to go at that time. Or you may say, I want to give it to this 501c3, but I want to give in increments every year. Okay, so if it sits there and is given over time, it's two things. Number one, you get the deduction up front, and it's still going to go to the charity over time as you direct it to go. You can change who you want to give that to over time. But then the amount that is left in that savings account, if you will grow. And that income is tax-free and increases the amount that you give to charity over time. So that's a really cool one. Very simple, easy to recommend to clients without having to do any major legal stuff. You can go pretty much to any investment company and get one open up and started pretty quickly. All right, so now we're going to talk about qualified charitable distributions. It is a tax-free IRA withdrawal. So for those in retirement, this is a great way to work through those RMDs. Those required minimum distributions have to be taken, and you have to pay tax on them, even if you don't need the money. And we have some wealthy clients that don't need to take it out. They're living off other things or have other taxable income here or there. And so instead of taking that out, paying tax on it, and then doing what they want with it, they can donate that amount directly from their IRA. So they can say, here's my required minimum distribution. And instead of taking that myself, I'm going to give it to this charity specifically. It is, of course, limited to $105,000 annually as of now. But you can fund a CRUT, you can fund a charitable gift annuity if you have it. You can fund any 501c3 that you choose to give to. I know many people in the church world that when they're retired, they use those RMDs and use it as part of their tithe or giving to the church on a regular basis. This is also a really cool way to manage the tax liability for retirees. So specifically, if you've got someone who's a little lower on the income level and they are managing the limit or the threshold of when that Social Security becomes taxable and when those Medicare premiums become taxable or go higher, this can help minimize that because you're not taking it out as taxable income. It's being gifted before that, so it's not included in that income amount. All right. Last charitable one is the fee simple strategy. And most people think of this as just donating property that you already own, which it can be. So you've got property that you don't need anymore, you don't know what to do with it, you know you want to give it to a charitable organization. And so instead of selling it, paying the taxes, and then giving, you gift that whole property to them at whatever the fair market value of the property is, and you get that deduction that equals the fair market value rather than what your actual cost was. All right. It does reduce the taxable estate size, so it can minimize potential estate taxes. Very important that they must have a qualified appraisal done in order to determine that fair market value. So you can't just say, hey, oh yeah, I could sell this for 5 million and then get a deduction for that. Very specific in that. But the other side of this is you can do this through an investment. All right, you have to use a reputable company to do this. Tax Plan IQ has a preferred vendor out there, and they can take care of all the details. But the gist of it is, so this company is going to buy, say, a plot of land for $1 million. All right, they're going to get 10 investors at $100,000 each. And then for that $1 million land, they're going to create a development plan and then have the property appraised. So they say once it's developed, the appraiser says it's going to be worth $4 million. So then the 10 investors are going to vote to donate that $4 million property, the appraised value, to the nonprofit rather than actually go through and develop it. And so with that, they get a $400,000 deduction on that appraised value rather than the $100,000 of their investment. So in general, you're going to expect around a 3 to 4 time deduction for this kind of investment. But again, make sure you get with a preferred vendor to do all of this. Very important to note that it is limited to 30% of your AGI in the current year as far as the deduction you can take, but you can carry it forward up to 5 years. So a beautiful little way to plan around that. Okay, so those are some charitable strategies. We are going to skip over the defined benefit plan, not because it's not super important, but because Miss Jennifer Baker just gave us all of the things that you ever need to know. And you can always come back and look at more slides because they're so pretty and fun to go through. And then we're going to get to the next one. All right, strategy number 5 is captive insurance. All right, this is a strategy that has a high level of complexity to it. And so you're going to learn the basics of it. You're going to know who's going to benefit most from it. And then you're going to get your client in touch with a preferred vendor so they can do all the compliance work. Got it? All right. What is captive insurance? It is self-insurance. So your company creates their own insurance subsidiary to manage the risks and tailor coverage, reducing reliance on commercial insurers. So what this is going to do is give you a cost savings. The premiums are going to be deductible and potential tax deferred income from underwriting and investments. All right, the premiums that you have to pay are deductible, but they also go to you as the captive insurer rather than a commercial insurer. All right, so if you don't use those funds, they're going to continue to grow tax deferred. All right, combating growth, you know how you pay your insurance companies year over year over year and never use it. They're making money on that. And so you are going to be the one making money on that, which is awesome. All right. Tailored risk management. You can customize the policies to fit unique risk profiles that you may not typically have coverage for by a commercial insurer. So it gives you a lot of flexibility in that. How do you set it up? You're going to do a feasibility study to assess if captive is a viable option for the business, because it's not for everybody. You're going to get it formed, making sure that you have the favorable jurisdiction or domicile. All right. And then you're going to ensure compliance with local insurance regulations, which vary by every state. Like, for example, Vermont has a very supportive regulatory environment. But the biggest thing is that you get yourself with a preferred vendor to work with the client and don't do it yourself. All right. So a really great strategy can help keep money in your pocket and get some deductions along the way. I say your client's pockets without or saving some money along the way, but make sure you get your preferred vendors involved. All right, we're going to talk about solar energy tax credits, yet another government subsidy that we love. All right, so they're going to use our money, our taxpayers' money, and give them a benefit via a credit or deduction on their taxes. And so solar energy is one of these. It can be for residential or commercial property. And then we're also going to talk about how it can also be an investment. The majority of this presentation, we're going to talk about direct solar improvements. So adding solar panels to your personal residence or to a commercial building that you own. It is good to note that rental properties are not eligible for the residential credit, but could qualify for the business investment tax credit. All right. So yeah, while we're going to focus the majority of the rest of this on the direct solar improvements, you can partner up with some preferred vendors to offer solar energy credits as passive or non-passive alternative investments. All right, allows you to like capitalize on those tax savings. Passive means, I think we all know this, but it means that you can only offset passive income. So it's a passive deduction to offset passive income. Non-passive or actives means that you can offset ordinary income. That is going to be a little bit more risky. In the caveat, you have to have the client has to have a certain number of hours per year to be an active participant, similar to the real estate, the active real estate. I can't think of the word right now. I think y'all know what I mean. Point is, preferred vendors, they're in Tax Plan IQ. On the passive side, Vistia is the one you're going to want to talk to, and Valor is the one for the active non-passive. Both incredible companies to work with. Big thing to note is that you've got both federal and state incentives for this. So federal is 30%, right? But each state that does offer it will be a little bit different. So look into that, but there's a way to get a pretty big tax impact on that. Timing on this is that they have to be installed before 2032 in order to get that full 30%. And then it starts to phase out, as you can see, down in 2033 and 34. Those seem so far away, but I don't think they're that far away. I just want to say thank you. Like, we just went through so much information. I did talk fast because that's what I do, but hopefully it wasn't terrible. But remember, there is no way you will become an expert on all of this in one day. If you haven't yet gotten the VIP package, go ahead and do it. It does include the recordings, but you also get Dr. Jackie's ebook on the strategies, and you can go through and nerd out on all of the slides that I didn't read line for line and word for word. Okay. If you don't already have it, go ahead and get Tax Plan IQ. And if you do have it, use it, because the resources in there are completely invaluable. So you go to the tax strategy section, you've got details on who should use it, who shouldn't use it, the resources, including webinar videos. You've got Dr. Jackie doing a lot of webinars that are available out there for you to go in depth, like how Jennifer Baker went over cash balance plan in 20 minutes. And I've got, 6 strategies to go over in 40 minutes. It's fine. You get webinars for specific strategies, and you get access to preferred vendors. And then when you've got further questions on specific strategies, you can just go ahead and reach out to those preferred vendors and begin that relationship. Let them answer those questions, get to know them, how they're going to work well with your clients. So to reiterate what I said at the beginning, know your clients, build your arsenal, and then utilize Tax Plan IQ and collaborate with experts. Businesses can literally save hundreds of thousands of dollars in taxes annually with just one of these strategies, much less a combination of them. And I tell people all the time, I've got 40 different strategies we can use. Let's focus on these few today, stack the strategies, how are going to work best for today, and begin planning for tomorrow, but leave space for whatever fun stuff comes up. And then later, I'm just going to say later, Jackie's going to talk about how to get paid for the advice that you offer. And so That's all.
Yes, ma'am.
Well,
Awesome.
we have a little bit of time too, is what I was going to say, and we had some questions come in. So if you're game, let's answer some of those. Okay.
Let's try.
All right,
Also, a
so
lot of celebrations. Everyone in the chat, please make sure you check it, Michelle. Everyone loved your speech. They thought you did an amazing job. Thank you so much.
yes, great job. All right, so questions. So the first one, how do we define high net worth individuals?
That's a great question. Jackie, do you have an actual definition for that?
I think it varies. So, I mean, you've got your accredited investor definition. For me at Meyer Tax, we tended to lean towards people that had 5 to 10 mil of net worth. And then we're also still in a higher tax bracket. And then we didn't necessarily exceed like 30 mil of net worth. I felt like that got them into, top 100 firm type stuff. Go ahead, Michelle.
Yeah, I was just going to say, at our firm, we kind of combine high net worth with multiple streams of income, because you can make millions of dollars on a W-2, and there are strategies that you can use, but there are limited strategies. So when I'm looking for high net worth clients, I'm looking for those high net worth clients that have multiple streams of income or the ability to do that, because when they have entities, specifically several entities, you get to maximize the different strategies that are available out there.
Good stuff. Next one I can answer. Do you have a preferred vendor that you recommend for R&D? Yes, Engineered Tax Services, ETS, is our preferred vendor in Tax Plan IQ. So if you go underneath that strategy, you'll see them there and in the vendors area. Would the FLP be ideal if the current owner wants to transfer or sell the business to a child working in the business?
Yeah, I mean, you can, utilizing the valuation discount, you're going to be able to transfer it at a lower value. You can still have the purchase and the acquisition and kind of set that up in there. But the whole goal is that you can do it over time or at any significant period in time. So if you've got your beneficiary or your child working in that company with you, maintain control until you know that you've had the chance to educate them so they can actually take over and be able to carry on what you've already started and created, or your client has started and created. So I think that's a pretty great scenario. Yeah.
Do you have ideas of R&D investments, types of companies or activities that qualify?
Jackie, do you have any specifics on that?
I don't. I would work with Engineered Tax Services to see what kind of options they might have.
Yeah. Aren't fee simple plans under intense scrutiny by the IRS? Now, Chase from Vistia is on, so I think he'd be best to answer that. So they're our preferred vendor for fee simple. So Chase, can you come on and answer that maybe?
Yeah, I can. Sorry. Michelle, you crushed that. So I'm glad I was paying attention. You did a great job on that. I love the presentation. Fee simples are under investigation by the IRS. Yes, I think like a lot of things, it's about how they're set up and how they're done, and ultimately the developer putting everything together. I think like anything out there, let's take captives. 10 years ago, captives were under intense scrutiny. The IRS came out with some regulations, and now they're just kind of like everything else, and they're done correctly or not correctly. Has there been an intense audit in the conservation easement space that changed in 2022? Yes, huge space. Fee simples, have they come under extra scrutiny? And do developers plan for audits? Yes, they do. And so I would say yes, they are more scrutinized than certain other charitable deductions, but I think it's an ebb and flow in all things. Michelle, would you disagree with any of that?
Sorry, I'm muted. No, I 100% agree with that. I think this is when it's good to know your clients, whether they are more conservative, risk averse, just want to get out there and try everything. But I can't stress the importance enough of getting with an accredited, that's not the word I want to say, a preferred vendor with Vistia, somebody that knows all of the ins and outs, because we can't know enough to keep ourselves out of trouble. And I love the color orange, but not that color. So I don't want to go to jail for doing something.
Not that color. That color is not a good color. I would agree with you completely on that one. It's not a good color. We want to stay away from that one completely.